Welcome to our 2024 webinar series. Throughout this series, we'll shine a light on 3 common client types that the fee-only financial advisors often encounter. Follow the Green family as we illustrate the importance of lifetime insurance plans. So who are the Greens? We have a married couple, Harry, a financial planner, and Lauren, a stay-at-home parent. A non-married couple, Kevin, a cardiologist, and Irene, a dentist. No kids yet, but possibly in the future. And Sarah, a single working female as a software engineer. Each webinar will last about 15 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's presenter joined LLIS in 2008 and has over 20 years of analyzing, studying, and research annuity solutions. Here to present on annuities is Jerry Skapiak.
Thank you, Claudia. Welcome, everybody. We're going to talk about a couple of things today. There we go. So we're going to work with the Greens. We got Harry, who's a financial planner, Lauren, who is a stay-at-home parent. And we got Kevin, the cardiologist, and Irene, the dentist, and then finally Sarah, the software engineer. So we're going to talk about a couple of different types of annuities today. We're going to look at fixed deferred annuities. We're going to talk about immediate annuities, my favorite kind of annuity. Deferred income annuities, which have been gaining popularity lately. And also qualified longevity annuity contracts, which have also gained popularity. Now, probably the most popular type of annuity being sold right now is indexed annuities. We will talk about them for a little bit. I'm not a huge fan of them. I believe they are more complicated than variable annuities and how they work and clients understanding them. But they do have a place when used appropriately. And we'll talk a little bit about the hybrid annuity. So let's get started talking about fixed deferred annuities. So what is new in the world of fixed annuities? Well, it's the interest rates. From the 80s, interest rates have been coming down until we hit, sometime last year. Then we finally saw the rates starting to go up. And rates peaked around, at least with annuities, in October of last year. You can see we were able to get 5-year or 7-year rate at 6% here. And then rates have been steadily coming down. This month, they actually took a bit of a drop coming down, the annuities. Actually, the 5-year rate is actually, the 3-year rate is I think at 5.05 right now, and that 5-year is at 5.2. So we've seen a bit of a drop in the annuities, about roughly 40 to 50 basis points lately. But when you compare it to like where they were for the last 20 years, they are still substantially higher than what they were. I have no idea what interest rates are going to do. I get asked that all the time. If I had a crystal ball that told me those things, you wouldn't be talking to me right now. I would have a nice cushy job on Wall Street predicting what interest rates are going to do. But I don't have that crystal ball, and that's why I am talking to you today. So interest rates are starting to go down, but like I said, they are still a great opportunity for clients if they're looking for like that immediate annuity or want to get out of the volatility of the market, looking at a fixed deferred annuity. They're still a great option for them. So let's talk a little bit about fixed deferred annuities. What do you get with them? Well, first, you're getting a guaranteed interest rate. Think of a CD. That's how these work. Maybe you know them as MIGAs or multi-year guaranteed annuities. I like to refer to them as fixed deferred annuities because that's technically what they are. You're going to get a fixed rate for a set number of years, whether that's a 2-year rate, 5-year rate, 10-year rate. All fixed annuities have a surrender charge, and that surrender charge on most of them, at least at the annuities we use, is going to match whatever rate period the client has elected. So for example, if they pick a 4-year fixed rate, they're going to have a 4-year surrender charge. If they choose a 10-year rate, they're going to have a 10-year surrender charge. And even though they have a surrender charge, clients are able to take a certain amount of money out of the annuities without paying a surrender charge. Now, it used to be very common that that free amount was like 10%, even 15%. Insurance companies trying to be more competitive have been reducing the free amount they're looking for. It's not uncommon to see maybe 5% or 3% they can take out a year. It may be interest only. It may be interest only starting the second year. But they can take a certain amount out if you have a client that is looking to take out the traditional, what I call the traditional 10%. Let me know and we can look at annuities that allow that much to be taken out of them. So what is the surrender charge on an annuity? Why must there be a surrender charge? Well, it's the fee against the policyholder for early cancellation of the annuity. And what it's done, it's designed to recoup the commissions paid to agents and the underwriting expenses of the annuity. Now, it's not underwriting like you're thinking of life insurance. It's more financial underwriting. Insurance companies want to make sure that them putting the money in the annuity is an appropriate investment for them. I'm sure you've all seen your clients with annuities and you wonder why someone had put them in it. Well, insurance companies are trying to prevent that from happening. So they're taking a little closer look at the clients purchasing annuities, trying to make sure that they are suitable for them. And normally that surrender charge is decreasing on the annuities. So normally a surrender charge may start at 7%, maybe 5%, and will decrease by 1% each year. When you get into the index annuities, those surrender charges may be longer, especially if they have bonuses on them, and they may not quite decrease by the full 1% each year, or at least in the early years. Taxation of annuities. Gains are taxed deferred while they are in the annuity. So any money that sits inside of an annuity, clients don't have to pay taxes on it. That's why they're considered retirement vehicles for clients. But when they take money out, it's LIFO, last in, first out. So the gains are coming out first and will be taxed to the client. And the taxes they pay are ordinary income taxes. They do not get capital gains taxes on money inside of annuities, or in this case, retirement vehicles. And because they are retirement vehicles, if they take money out before they are 59 and a half, they have to pay a 10% penalty on those gains they withdraw from the annuity. So once again, here we are with the current interest rates. We got that 3-year at 5.05, and then you can see they're going up, and the 10-year rate has fallen. We are kind of getting more in an inverted yield curve with fixed rates. I think I just saw something. This is one of the longest periods ever where the yield curve has been inverted. A lot of people like to stick with, or a lot of advisors and clients like to stick with that 3 or 5-year rate. But there is a case for using a 10-year rate. If you have a client that has a fixed annuity and their whole goal is to leave that money to their beneficiaries, and they're getting up there in age, there is a maximum age at which point you are not able to purchase an annuity anymore. So let's say you have a client who is 89. Most annuities stop being offered at age 90. There may be a company out there that will go to 92. So if you have this older client who just wants to pass on the assets in the annuity to the beneficiaries of it, those older clients is when we look at using that 10-year rate, because we're able to lock it in for 10 years and they get that rate. Also, annuities have what's referred to as a maturity date. In fact, I just had an advisor that was questioning me about it today when he was looking at a client's contract. Maturity date is when clients must absolutely have to start taking money out of the annuity. You can't just leave money sit in the annuity forever IRS wants their money. A lot of times that maturity date is set at age 90, 95 for clients. That's one. So a way to avoid that, having them to start taking money out, you can move it to the fixed deferred annuity with a 10-year rate. It avoids it at least for another 10 years before they have to start taking money out, and allows them to pass those assets on. So now we're going to talk about immediate annuities. My favorite annuity, probably the annuity that we help advisors, clients with the most. Common question I get asked is, how much guaranteed income should be purchased? Well, you want to make sure clients' fixed expenses are covered with guaranteed income. So like mortgages, make sure because that mortgage is going to be recurring, or you can replace the word mortgage with rent. Utilities like electric, water, they need to eat, so you want to like cover like what their average grocery bills are. And insurance premiums, you don't want to forget that, like especially like say they have a long-term care policy, you want to make sure that money's coming in every month to pay those premiums. So what you want to do is you want to look at like what the fixed expenses are for the client, and then take that into account, like what they're receiving from Social Security, if they're fortunate enough to have a pension. If they have a shortfall at that point, then consider looking at an immediate annuity to provide income to the clients. So with an immediate annuity, we have several different payout options that are available to clients. You have period certain, non-lifetime payments, so they're going to pay for a certain amount of time, or you have lifetime payout options for clients. So with a period certain, it's going to pay for that set period of time, and will stop at the end. So let's say, for example, the client has a 10-year period certain annuity. They're receiving their payments, and they pass away after 6 years of receiving payments. Well, that annuity is guaranteed to make payments for 10 years. So what it will do, it will start making payments to the beneficiary for the next 4 years, fulfilling that 10-year period certain, and then the payments stop. Annuity is fulfilled, annuity goes away, annuity's done what it was meant to do, make payments for 10 years. But what's most common is lifetime payments, and we have several different payout options with lifetime. So a life-only payout is the payout that will typically provide the highest payments to your clients. Will make payments as long as they're alive. Once they pass away, payments stop. So they can literally take the annuity out, receive a payment, pass away. Insurance company is going to keep the rest of the premium. A lot of clients don't like that idea, especially if they have beneficiaries. Beneficiaries aren't happy if that happens to mom or dad, that they put all this money in an annuity, not much was received from it, and it's money removed from their estate that could have went to them. So then you have payment options that offer guarantees. Of course, when you start adding guarantees, the payments start going down a little bit. So first you can do a life with a period certain. So that annuity is going to pay for as long as that client's alive, or at a minimum, whatever that period certain is. So let's say we have a life and a 20-year period certain annuity. Clients receiving payments, they pass away after 15 years of receiving payments. The annuity will continue to make payments to the beneficiaries for the next 5 years, fulfilling the 20-year period certain. If the client lives and receives payments for 20 years and 1 month, the annuity payments will stop. Annuity's finished, period certain's been fulfilled. Insurance company keeps whatever money's left. My two favorite payout options are life with installment refund and life with cash refund. Go back to our example. Client puts in $100,000 into the annuity. They start receiving payments. They've received $80,000 worth of payments, and then they pass away. The installment refund option will continue to make payments to their beneficiaries until the other $20,000 has been paid out. The cash refund option we'll just write a check for the $20,000 to the beneficiaries. So what I always like to say, it depends on if the client wants to rule from the grave, or say they have a spendthrift beneficiary. They want to go with that installment refund option because it's not going to give the beneficiary a lump sum. It's just going to continue the payments to them that they were receiving themselves. The cash refund option, you have a responsible beneficiary. You can hand them the lump sum of money and everything will be fine. So here is an example of where payouts are today. So here we have Sarah, age 71, putting in $200,000 into her immediate annuity. And this is going to be for non-qualified because we have an exclusion ratio. We're going to talk about exclusion ratio in a minute, exactly what it is and how it works. But I want you to focus on what the monthly payouts are. So life only has the highest payout, pays $1,379. And as the guarantee gets longer, that payout goes down. I would say life in a 10-year period certain is the most common type of payout that we see advisors using, and that would be $1,332. My favorites, the life with installment refund or cash refund, are a little bit lower, and you can see there's very little difference between the two payout options. Once again, it goes back to, do you want to rule from the grave or do you want to hand a lump sum to the beneficiary? So that's what we have here. Now you can also, with these annuities, set them up as a joint payout. So we have all these same payout options with a joint life. You can do it with a joint life with a period certain, installment refund, or cash refund. And you can even reduce the payments upon one of their deaths. Not very common. We use that more often when we're trying to compare to a pension payout that someone may be having. But the vast majority of clients go with 100% payout to the survivor with a joint payout. And here's an example of what the payouts are. Here we have Kevin and Irene. Kevin's 66, Irene 64. We're going to use the same $200,000 in it. And you'll kind of notice with this that our joint life is $1,072, and it's the lowest payout on here. Seems a lot contradictive to like what we all believe and what I kind of just said when you add guarantees onto the payouts, that it costs to do that, but with a joint payout, it's not always necessarily the truth. The reason we're seeing the payouts like this in this case is because insurance companies were simply getting sued by beneficiaries. Mom and dad were buying a joint payout SPIA. Something happened. Maybe they both died in an accident. An insurance company was keeping all that money. So what insurance companies have done to kind of stop that from happening is they modify the payment. Now, we're seeing right now, they're both fairly young, where we're getting this, that it's the lowest payout in there. If they were both in their 70s, the joint life would more than likely be the highest payout, but it would cost very little to, say, add a joint and a 10-year period certain to it. They're really trying to prevent people from electing just the life only. They really want them to add some type of guarantee onto it. All right, I see we got some questions in. Are there commissions for free annuity products that a fee-only RIA can use today? Yes, are the terms better than commission products? Great question. So with immediate annuities, it is the simplest product to compare. You're going to put in X dollars and receive Y dollars per month, whichever product has the highest payout. We do work with a company that has a reduced commission product, and they don't always necessarily win. It's from a large insurance company, and depending on how much business they're getting across the board and other stuff, they manipulate their payouts. So not always is a reduced commission product the highest payout. Um, but I'm always looking to see which company has the highest payouts for your clients. Any of you that have purchased an immediate annuity through us know that a lot of times before your client is interviewed, we go out and check the market one last time to see which company has the highest payout, so we apply with the best company for your clients. So what are the client's options of choice to fund to purchase an annuity? Can IRA funds be used? Yes, you can use either non-qualified or qualified money. You can use Roth money to fund an immediate annuity. Does not matter. Insurance companies will take it all. So this is actually a good segue talking about IRA money, and let's talk about this exclusion ratio. So it's the exception to the rule where annuities pay out gains first, and this only applies to immediate annuities. Does not apply to other types of annuities that may have income riders on them. This exclusion ratio only applies to immediate annuities. When a client annuitizes money, it spreads out those gains over the insured's IRS expected lifetime, not their actual lifetime, but what the IRS states their lifetime should be. So basically, the IRS basically says you got to have the cost basis returned to the client within a certain amount of time. So each payment is then part cost basis, which is tax-free, and part gain. So I'm going to go back to this, and we'll just use this. So if we look at the life only, we're going to receive $1,072 a month, and the exclusion ratio is 62%. So what that's telling us is that of that 1,072, 62% of that is going to be a return of cost basis, and then the other 38% is going to be interest that's been earned inside the annuity. So you get this exclusion ratio when they hit life expectancy, and for them is going to be roughly around age 78-ish for Kevin. All of the cost basis will have been returned, and then 100% of the payments will be fully taxable to them. If it was a qualified annuity, there's no exclusion ratio. It's all 100% taxable to them. All right, and let me see. Is an IRA money unlimited if the client is buying a charitable gift annuity? We do not offer charitable gift annuities here, so I am not qualified to answer that question. Do most annuity purchasers annuitize, or do they just take monies out when needed without annuitizing? That depends on the clients. We have clients that have purchased the fixed deferred annuities or MIGAs that take the interest every year. They want to maintain that principal, and we have a lot of clients that annuitize. Just depends on what their goals are that they're trying to accomplish. That's a conversation that we can have and you can have with the clients, or all three of us can have to talk about to see what's the best route for them to go. All right, I don't see any new questions. We'll keep going here. So money going into immediate annuities have limits. And I'm really surprised there's not limits on all types of annuities. But for non-qualified money, the most you can put in is 50% of a client's investable assets. And that is a pretty hard rule. The 100% of qualified money that can go in, we can do that as long as they have some other assets also. Basically, when someone purchases an immediate annuity, they're giving up full control of that money. They don't have access to it. So if they have an emergency and need money, they can't get any additional money out of an immediate annuity. So that's why insurance companies have put these rules into place. All right, deferred income annuities. Let's change gears a little bit here. So what is a deferred income annuity? Well, it's a cross between a deferred annuity and an immediate annuity. It's going to insure your clients against living too long. You may have heard these products referred to when they were first coming out as longevity insurance. Same thing, it's a deferred income annuity. They are usually used as a supplement to retirement solutions. So my prior life, when I used to work for a home office, I worked for a company that was actually one of the first companies to come out with a deferred income annuity. And we worked with some actuarial companies when developing it, and did all kinds of studies on the effects of having or adding a deferred income and annuity to a portfolio for a client. And when they were running stochastic modeling or Monte Carlo simulations, when a deferred income annuity was added to the portfolio, the success rate of the plan making it to age 100 increased. Or if the plan was already making it to age 100, they were able to increase the withdrawal rates the client was able to take out today. So there are some benefits to these products when added to a financial plan. I'm always happy to run numbers for you. You can plug it in and see how it works. May make some sense for your client. So what are the features to a deferred income annuity? Well, first off, they are a single premium product. That single premium could be qualified or non-qualified money, does not matter. We're going to guarantee future income stream to start 2 to 30 years in the future. You can defer up to age 85. Age 80 and 85 are the most common ages to defer that first payment. If you are using qualified money, you have to start payments by age 72, because that's when they have to start taking RMD distributions from that money, unless we do a QLAC, and we're going to talk about QLAC next here. But just remember that if you want to put in more than the limits of a QLAC, you have to start taking payments by age 72. But for non-qualified, you can defer those payments all the way out to age 85. Payout options are the exact same as a SPIA or immediate annuity. No lump sum payments from these products. So they are meant to, you're going to put money in, it's going to sit in that annuity, it's going to start making payments out there around age 80, 85. There is a death benefit available on them. So what does that mean, a death benefit? Well, you're going to have this long deferral. You're going to put in $100,000. You're going to defer payments to age 85. So what happens if the client dies before they begin receiving payments? Well, without a death benefit, insurance company keeps the money. With a death benefit, the insurance company will pay whatever that premium was back to the beneficiaries. So they do lose, obviously, time value of money of that, because they're not going to pay any interest on it, but they are going to return that original premium back to the beneficiaries. Taxes on them. There are none due to the owner. They're only due when they start receiving payments. So this is where the deferred part comes in. All the interest earned inside the annuity grows tax deferred. It is only taxed when they start receiving payments. And because it's a cross between a deferred income annuity and an immediate annuity, you have an exclusion ratio with them when they do start receiving payments. Let's see, I got some other questions coming in. For the annuity payments, would it go by the current RMD age of 73 or 75? Thanks. It's going to be what the current RMD requirements are for a QLAC, or if we're using qualified money and how long they can defer it before payments have to begin. So it's going to be whatever the RMD rules are for their age. So QLAC. A QLAC is basically the same thing as a deferred income annuity, but with some limitations. So those limitations are your single premium. You could only put in up to $200,000 of qualified money, has to be qualified money, no Roth money can go into the product. Your payout options are not the same as the SPIA. You're limited to two options, life only or life and cash refund. Remember, life only will pay as long as they're alive. When they pass away, payments stop. Life and cash refund is guaranteeing that whatever was paid in will be paid out. And if they die before they receive back their original premium, it will just write a check to the beneficiaries, and you can defer the QLAC payments starting up to age 85. Another benefit to this is the money that goes into a QLAC is excluded from RMD calculations, which can reduce their taxes. So for your clients that have qualified money, they're receiving Social Security, pensions, they're receiving all the income they need, and they're getting to that point where they have to start taking RMDs, and they really don't want to, you can shelter $200,000 into a QLAC and prevent them from having to take RMDs on that $200,000. So it's a nice little benefit you can get with that annuity. So here are where payouts are. I put them up here with a death benefit and without, so we can look at the difference here. So let's just look at the single life. With a death benefit, we got Harry's putting $100,000 in. He's going to start payments at age 85, which is the most common age when people start payments with these products. With the death benefit, his payments are $4,225 a month, and that will pay for as long as he lives. Without the death benefit, it is substantially higher. Well, you got to think about starting payments at age 85. He's already beyond life expectancy, even beyond the average life expectancy an insurance company calculates for immediate annuities. When someone's purchasing an immediate annuity, insurance companies are assuming that they are a preferred health class and are going to live well beyond what the IRS calculates as life expectancy. So insurance companies are already assuming a client's going to live longer than an average person. So when you're deferring to age 85, you're even living beyond the average age an insurance company is going to say. So they're getting a nice bump in that payout between with a death benefit and without a death benefit. And you can see if we add on life with 10-year period certain, with the death benefit, it's just a little bit of a hit, about $1,000 a month. But when you go without the death benefit, it's even more of a hit adding on that guarantee, because now we're guaranteeing those payments out to age 95. And then with the cash refund option, it's not too bad having it with the death benefit or without the death benefit. All right, I got more questions here. Have there been more QLAC purchases since interest rates have risen recently? Yes, both QLAC and deferred income annuities, there have been more purchases of these products happening. Do QLACs have to be single life that is not joint, since funding comes from qualified money? So with qualified money, you can do them as joint payouts. You can do them as individual if you want. Most people, if they're married, are going to do a joint payout. Every now and then we do get married couples, only one of them doing it as a single life, but you can do them as joint. And I believe that answers that question. Yeah. All right. Okay. Indexed annuities. So, for those of you who are not familiar with index annuities, um, performance is tied to a particular index, but it is not invested in the actual market. So common design will be the client's going to buy an index annuity. They're going to invest in the S&P 500 index. What they do is they get caps with the product, and there's a floor. So the cap is going to be some interest rate, which is going to be the maximum they can earn, and their floor is zero. So the elevator pitch for an index annuity is very simple and straightforward to clients. Would you like to be able to invest in the market without having to participate in any of the downside of the market? And that's kind of what you get with an index annuity, because the client thinks they're investing in an S&P 500 index, and if the index does bad, they can't lose any money. But investing in the S&P 500 index, it's just used as a guideline. They're not actually investing in the index. For one, in the calculations that an insurance company use, the client doesn't receive any of the dividends that are paid by the companies inside the S&P 500. And from what I've been told, that can be about a third of the return of the S&P 500. So they're missing out on that right away. So I know this example's old here. It's purely just an example to make a point with these products. So here we have, and this was taken from an actual product back in 2019, the floor was 0%, the cap was 6.85%. And here are the returns that the S&P 500 returned over those years. So when we look at 2011, S&P 500 was fairly flat that year. So what the client earned was zero. 2015, the return was a negative. The client earned zero again. Clients that are looking to buy an index annuity, they like that comfort, they like that security, knowing they cannot lose any money being invested in the market. And if we look at 2018, the market was down 6%, they got zero, so it stayed the same. But when you look up, and we're going to look at 2009, market return 23%. They got what their cap was on the annuity, they earned 6.85. These annuities are often don't have any fees tied to them. They're not like variable annuities where you have an M&E fee, you got an administration fee, you have sub-account fees. These annuities don't really have any fees on them. But to me, the fee is hidden with these annuities. They could have earned 23.45%, but they didn't because the cap on the annuity, they earned 6.85%. Well, in turn, had they just been invested in the S&P 500 during this time period, instead of having a $159,000 account value, they would have had $277,000 had they invested in the market. But also, the flip of this is also true. Here we have the worst 10 years for that time period. You know, we take a look at 2002, down 23%. They earned zero. They have their 106,000 that they had. 2003 went up 26%. They got their 6.85% return. Had they been in the market, they would have lost some money. They would have been down to 73,000 roughly had they been invested in the S&P 500. But because they were in the index annuity, they get almost 139,000. So it kind of, it depends on the risk tolerance of the client. Some clients like that security they can get, knowing they can't lose any money, but yet they can participate in the market some. Not a lot of your clients, but there are some, and we do see them. All right. Um, so with index annuities, you're getting the protection against the downside is why clients like to purchase these products. But they need to read the fine print with them. Um, it's likely, we've seen this if we've ever worked with securities that basically past performance is no guarantee of future performance. Um, most strategies are a 1 year point-to-point strategy. They have a cap that's going to have a guarantee. And, you got all kinds of different verbiage in the bottom of these illustrations. So this was back in the time, cap on September 5th was 6.85. Uh, we had the client go back. We were trying to get them to make a couple of changes to the illustration they were looking at, and literally 2 days later, the cap was reduced. So when we were looking at the examples before, we used that same cap, 6.85. But in reality, that cap is going to change every single year in the index annuity. It's going to go up, it's going to go down. Um, these products, some of them will illustrate fantastic, and your clients are going to see that and they're going to want to believe that's what's going to happen to them. And it's so hard to convince clients when they see some of this that it's not going to happen to them. And so we don't know what the cap's going to be next year or in 5 years with them. Where I do like the index annuities is when we look at them to use them for income riders. In fact, lately we've been starting to get higher income from index annuities using the income riders on them. I don't fully understand why. All I know is that when we look at them, we don't look at the fluff part of illustrations. We actually look at the 0% rate of return of the illustration. So we remove all the market fluctuation out of it, and we're looking at purely what is guaranteed with the income rider on those annuities. And we're looking just at the guaranteed growth of the rider, what the guaranteed payout's going to be, depending on whatever age they're wanting to start taking income from, and they're producing higher income than we're seeing with immediate annuities right now, especially when we start income immediately with them. So don't necessarily discount index annuities. If you come to me looking for an illustration for an immediate annuity, I may show you an immediate annuity. I may also show you an index annuity along with it that may provide a little higher income. If your client wants to do it, they're a little more complicated with it. You do got to kind of manage which indexes they invest in. But as far as when we're looking at them for income, it doesn't really matter what they invest in. We're looking at it more for what that guaranteed income rider can do. All right, hybrid annuities. So what is a hybrid annuity? It is simply, it's a fixed deferred annuity that has a long-term care rider added on it. What that rider does, it's going to give you a long-term care pool of 72 months for an individual or 102 months joint. There's minimal underwriting with these products. They're basically looking to see if someone would qualify for to go on claim right now for long-term care. Now there are some knockout things like if they have Parkinson's or showing signs of dementia, they'll be excluded from being able to get this product. But out of long-term care products, this has the simplest underwriting to get a client long-term care coverage. So if we have a client that applies for traditional long-term care or maybe even a hybrid life product and they're declined, we'll take a look at a hybrid annuity because we still might be able to get them coverage. They are single premium only, and it has to be non-qualified money. You cannot use qualified money in these products. You can add a spouse to annuity. You can have a client that has a life insurance policy or say they have an annuity just in their name. We can do a 1035 exchange to the hybrid annuity and add the spouse on so she's also covered for long-term care insurance. I can 1035 exchange money into it, non-qualified money only, and there is an option to add inflation on it of 5%. That's the only option, and it's only to part of the annuity, and we'll take a look at that in a moment. So here we got Kevin and Irene. They're age 55. We're going to look at a $3,400 monthly long-term care benefit. It's going to be 72-month benefit period. Should actually be 102-month benefit period. Sorry, that's a typo on my part. And it's $180,000 premium to get them to the $3,400 a month. So the $180,000 is also a mistake. It should be a $100,000 premium. I apologize for that. So their account value, when you look at an illustration for a hybrid annuity, you're going to see these columns on it. Account value, surrender value should be self-explanatory. That's their money inside the annuity. The long-term care accumulated value, it's nothing more than their account value growing at a slightly higher interest rate, and that is what the monthly long-term care benefit is calculated off of. And then the long-term care rider, that's the additional long-term care benefits. You have your total long-term care balance or long-term care pool, and then what their monthly long-term care benefit is. Now, when a client goes on claim and they start receiving long-term care benefits, the benefits paid out are subtracted dollar for dollar first from account value, surrender value, and long-term care accumulated value. So they basically use their own money first to cover the first part of a long-term care claim. Once they have depleted their long-term care account value on this, or accumulation value, that's when the long-term care rider kicks in. When they go on claim, let's say they're only on claim a little bit and there's still account value left and they both pass away, whatever that account value is paid to the beneficiaries as a death benefit. When it's a couple, and that's what we're looking at as a couple in this example, they can both be on claim at the same time. They can each receive the full monthly long-term care benefit. So it's kind of like having shared care for traditional long-term care. So they receive these benefits. It's a fairly simple, straightforward product. Works great if the client has an existing life insurance policy or an annuity they're not going to use for income and it's not qualified. We can transfer it to the hybrid annuity and get them long-term care coverage, and as a bonus we can add on their spouse. So Kevin and Irene, we're going to look at that 3,400 monthly benefit, 102-month benefit period again. That's kind of fixed in the product. But this time we're going to add on 5% compound inflation to it. Hitting the wrong button, sorry. And it's going to take a $217 or a little over $100,000 premium to get us there. Sorry, I grabbed this from another PowerPoint and forgot to adjust those numbers there. So what I want to focus on here is, I'm just going to jump to the screen here, is I want to look at the base policy and the long-term care rider on this policy. Our base policy is our own money growing here year by year, and that's purely because of the interest rate that it's earning inside the product. When you look at the long-term care rider, that is what's growing by 5%. So for example, year 4, a client goes on claim, they're going to receive $36.29 a month for long-term care benefits, and they'll receive that until they deplete that pool. So that's going to take them a couple of years. Let's say we get out to year 6, they deplete all the money out of it, then it jumps over to the long-term care rider, and they're going to get a bump in monthly long-term care benefits that are going to start paying them the $42.51 a month, and that will continue until that rider has been depleted. So today we've covered several different annuities. We looked at fixed deferred annuities, immediate annuities, deferred income annuities, QLACs, indexed annuities, and hybrid annuities. Let me see if I got any additional questions here. Could use an annuity, I'm looking at the deferred income or qualified annuity life with tenure certain by way of self-funding long-term care needs. Okay, I get asked this question a lot. So can you use a QLAC to help fund long-term care? For $100,000, you get about the benefit of an average long-term care contract, but with more flexibility. Granted, you're taking a chance on the timing of any long-term care needs. That's the point why we're using a deferred income annuity or a QLAC contract may not work when you're looking to possibly cover long-term care expenses. It's that timing, because we don't know when someone's going to need long-term care. So let's say you purchase a deferred income annuity or a QLAC, and you're going to start payments at age 85. Well, let's say one of them starts developing dementia and they start needing care at 77. That QLAC or that deferred income annuity is not really going to do any benefits at that point, because it's not going to start making payments until age 85. That's really why they don't work in that scenario, trying to use it for that. Can you repeat the use your own money first when on long-term claim? What column is used? Sure. Let me jump back here a little bit. All right. So when I say use your own money first, when you go on claim, money is going to be subtracted dollar for dollar from the account value, surrender value, long-term care accumulated value. That is your money. That's the client's money when they first put in that $100,000 they put into the annuity. That is their money that they're using in the annuity. And did you say that you can 1035 exchange a permanent life insurance policy into a hybrid annuity? Yes. When you can do a 1035 exchange from a life insurance policy to an annuity, you cannot do an exchange of an annuity to a life insurance policy. So you can do life into an annuity and an annuity into an annuity. All right. I don't see any other questions. So what makes LLIS different from other providers of insurance advisors out there? Well, one, we do these monthly webinars. Next month on September 10th, we're going to have assessing your insurance policies for optimal protection. We save fee-only financial advisors time and their clients' money by pre-underwriting to avoid surprises. If you've ever gotten life insurance quotes from us, you know sometimes we're sending out emails basically saying, hang on a second, we're checking with some insurance companies first. We like to quote as accurately as possible up front to avoid surprises in the end. We have specialists for the different types of products. I'm one of the life specialists and annuity specialists here at LLIS. We're sponsors of all these different groups that you guys are part of. Have you met Alice? If you've worked with us and received quotes, you've had to go through our Alice system to get those quotes. It's a great way to share sensitive documents with us. You can log in and see your clients, any types of quotes we've sent them, and where they are in the underwriting process. And that is all I have at this time. I hope you all enjoyed the webinar, and until next time, have a good evening.